Gold, 5,594 to 4,883. Silver, 121 to 83.99. U.S. 10-year yields, 4.1%. That price combination should not coexist. Gold is down nearly 9% from recent highs. Silver is down more than 27%. Yet long-end yields remain above 4%. In a stable macro framework, this configuration does not hold. High yields typically apply gradual pressure on precious metals. They compress upside. They do not trigger disorderly repricing across multiple metals simultaneously. But what we observed was not a repricing. It was a liquidity event. Under normal risk-off conditions, gold absorbs volatility. Silver underperforms, but remains functional. Yields decline as capital seeks duration. This time, all three relationships failed at once. Gold sold, silver collapsed. Yields remained elevated. This should not be happening. And when historical correlations fail simultaneously, the issue is rarely valuation. It is structure. Over the past 72 hours, market behavior shifted from two-sided price discovery to one-sided liquidation. Bid depth deteriorated rapidly. Dealer balance sheets pulled back. Spreads widened materially. Several metal-linked products triggered volatility controls near 20%, not due to information flow, but due to forced risk reduction. This distinction matters. Discretionary selling is slow, risk-mandated selling is immediate. The magnitude of silver's move, exceeding 27%, is not an expression of macro opinion. It reflects leverage concentration and exit constraints. Silver trades efficiently until it does not. Under stress, it transitions from monetary proxy to high beta exposure. That transition is mechanical, not emotional. During the same period, Bitcoin, often framed as a monetary alternative, declined roughly 13% month to date and nearly 8% in a single session. Multiple hedging instruments failed concurrently. That is not diversification failure. That is funding stress. When liquidity tightens, markets do not differentiate between narratives. They differentiate between liquidity profiles. If this were an inflation repricing, gold would have stabilized. If this were a growth reacceleration, yields would have expanded materially. Neither occurred. Instead, capital consolidated into cash. That outcome points away from macro interpretation and towards system mechanics. At the same time, external policy uncertainty amplified the move. The Japanese yen experienced intraday volatility near 1.7% on intervention speculation. Actual intervention, 0. Japan retains approximately $1.16 trillion in FX reserves, yet policy ambiguity persisted. Uncertainty, not action, tightened global liquidity conditions. In the U.S., parallel repricing occurred around expectations for the Fed's forward path, not due to a single statement, but due to shifting confidence in policy continuity. When policy credibility becomes uncertain, markets do not hedge outcomes. They reduce exposure. That is the context in which this move occurred. This is not a metals story. It is a liquidity hierarchy story. And what the market just signaled is that liquidity is being repriced before fundamentals. If you are still interpreting this move as an isolated asset correction, you are already behind the curve, because this was not the event. It was the warning. To understand why this sell-off accelerated, you have to step away from assets and look at policy credibility. Because markets didn't reprice rates. They repriced confidence in the path. In the US, expectations around monetary policy shifted abruptly, not because of new inflation data, not because of employment surprises, but because political signaling entered the rate framework. The market began to price a higher probability that policy decisions in 2026 may be constrained, not optimized. Rate futures adjusted quickly. Implied probability of near-term easing declined by roughly 18%. Real yield expectations moved higher by about 20 to 25 basis points. And the dollar held firm, up roughly 0.6% on the week. Under normal conditions, this would cap upside in gold gradually. It would not produce a disorderly move across metals. But when credibility erodes, markets don't wait for confirmation. They preempt risk. That's the key difference. This wasn't a debate about whether rates should be higher or lower. It was a reassessment of whether the reaction function itself is stable. And when the reaction function is questioned, duration is not the first hedge. Liquidity is. That's why the selling pressure concentrated in the most liquid expressions of safety, gold futures, silver futures, ETFs. These are instruments designed for entry and exit. In stress, they become funding tools. Now layer Japan on top of this. In the same window, USD JPY experienced intraday swings near 1.7%. Intervention speculation surged, but actual intervention volume, 0. No yen bought, no dollar sold. Japan holds approximately $1.16 trillion in FX reserves, yet policy signaling remained deliberately ambiguous. This matters more than it sounds. Japan is not just a currency story, it is a global liquidity anchor. When Japanese yields rise and FX policy becomes uncertain, capital repatriation risk increases. that tightens global dollar liquidity indirectly. Normally, that would support treasuries. It would lower yields elsewhere. But again, that's not what happened. Japanese yields rose, US yields stayed elevated, and global liquidity still tightened. Another correlation failed. Because this environment is not pricing direction, it's pricing fragility. When fragility dominates, markets don't seek duration or inflation hedges. They reduce gross exposure. This is why the metals move matters. Gold being down 9% while still up 12% over 30 days is not a contradiction. It's a sign that positioning, not conviction, drove the move. Silver being down 27% after being one of the strongest performers year to date is not about valuation. It's about leverage concentration. Silver's volatility profile makes it efficient in calm markets and unstable in stressed ones. That instability showed up immediately once margin thresholds were hit. And margin thresholds are mechanical. They don't care about narratives. They don't care about long-term theses. They care about collateral. When collateral values fall fast enough, selling becomes compulsory. That's why this move propagated so quickly across unrelated asset classes. Bitcoin, down 13% month to date, failed the same test. Not because it's flawed as an asset, but because in stress, it trades as risk capital. Multiple hedges failed together. That's the signature of a liquidity event. And liquidity events always precede macro explanations, not the other way around. By the time the story becomes clear, the repricing is already done. What you're watching now is not a debate about inflation or growth. It is a recalibration of how much risk the system can carry when policy signals are no longer clean. And that recalibration is still ongoing. If you think the damage is already done because prices have already moved, you're missing the point. The first wave is always the most visible. The second wave is where allocation changes. And allocation changes are what drive medium-term trends. Now we move from policy to positioning. Because policy uncertainty explains why liquidity tightened, but positioning explains why the move was this violent. Going into this window, precious metals positioning was not defensive. It was crowded. Gold had rallied more than plus 112% in 30 days. Silver had surged over 40% at the highs. ETF inflows were running nearly 2x their 3-month average. That matters. When a market becomes a consensus hedge, it stops being a hedge. It becomes a trade. And trades behave very differently under stress. In futures markets, open interest in silver was elevated while margin requirements were already tight. That's a fragile setup. When prices move against leverage, you don't get time. You get liquidation. Over a 48 to 72-hour window, forced selling cascaded across contracts. Not because investors changed their macro view, but because risk limits were hit. Risk systems don't debate. They execute. This is why silver dropped 27% without a meaningful bounce. There was no two-way flow, only exits. Gold behaved differently, but not safely. Gold's drawdown near 9% looks orderly on a chart until you compare it to volatility. Intraday ranges expanded by more than plus 160%. Bid depth thinned dramatically. That tells you something important. Even gold, the deepest metal market, was trading on balance sheet constraints. This is where the safe haven narrative breaks. Safe havens work when balance sheets are willing to intermediate. When dealers step back, safety is irrelevant. Liquidity becomes the only metric. Now zoom out further. The same dynamic showed up across assets. Bitcoin fell 13% month to date. High beta equities underperformed. Credit spreads widened modestly but persistently. These are not panic signals. They are stress signals. Panic is emotional. Stress is mechanical. Stress builds quietly, then releases abruptly. And when it releases, diversification fails. Not because assets are correlated, but because they share funding sources. This is the part most investors underestimate. They diversify by asset class, but not by liquidity profile. When funding tightens, everything funded the same way moves together. That's what you just witnessed. Now consider the implication. If this was purely a metal-specific event, the damage would be contained. But it wasn't. It touched FX, rates, crypto, and volatility structures. That tells you the unwind is broader. And here's the most uncomfortable part. This type of unwind does not end with a single flush. It ends when positioning resets and leverage is meaningfully reduced. That process takes time, which means the instinct to buy the dip is structurally punished in this environment. Because dips are not driven by fear, they are driven by constraint. And constraint does not respond to price, it responds to balance sheets. Until balance sheets stabilize, volatility remains asymmetric. Upside is slow, downside is fast. That asymmetry is the real signal. Markets are telling you that risk capacity is being repriced, not eliminated, repriced. And repricing phases are hostile to passive strategies and headline-driven trades. They reward patience, they punish reflex. If you are still anchoring to where prices were last week, you're anchoring to a regime that no longer exists. Because once leverage breaks, markets don't revert immediately, they reset. So let's be precise about what actually broke. Not gold, not silver, not Bitcoin, not even monetary policy itself. What broke was the assumption that the system can absorb stress without repricing liquidity first. For years, markets were conditioned to believe that when volatility appears, policy responds, liquidity follows, and risk stabilizes. That reflex is no longer guaranteed. And the last few days made that clear. Gold falling 9% while still being up 12% over 30 days is not contradictory. It's transitional. Silver collapsing 27% after a 40% plus rally is not irrational. It's mechanical. Yields staying above 4%, while safe havens sell off, is not a failure of macro logic. It's a signal that liquidity has priority over narrative. This is what a regime shift looks like in real time. Not a crash, not a crisis, a repricing of tolerance. Markets are asking a different question now. Not where is inflation going, not when does the Fed cut, but how much risk can this system actually carry if policy clarity keeps eroding? That's a harder question, because the answer isn't a number, it's behavior. When investors stop adding risk on dips and start reducing exposure on rallies, the entire character of the market changes. You don't get vertical rebounds. You get range, volatility, and false starts. That's why chasing price in this environment is dangerous, and why waiting for confirmation is often too late. By the time fundamentals look obvious, liquidity has already moved. This is not a call to panic. It's a call to recalibrate, because stress-driven markets reward a different skill set. They reward balance sheet awareness. They reward patience, they reward optionality, they punish leverage, they punish crowding, they punish certainty. If you're still framing this as is gold a buy here or is silver oversold, you're asking asset level questions in a system level moment. System level moments don't resolve with answers, they resolve with resets. The metal sell-off wasn't the story, it was the symptom. The story is that liquidity is no longer assumed, it has to be earned. And until policy signals regain credibility and positioning normalizes, markets will remain reactive, not predictive. That's the environment you're in. Not broken, not bullish, not bearish, fragile. And fragile markets don't warn loudly, they whisper first. The last few days were the whisper. What comes next depends on whether liquidity returns or keeps retreating. But one thing is already clear. If you're still waiting for the old rules to reassert themselves, you're not early, you're anchored. And anchoring is how capital gets misallocated during transitions. This wasn't the end of a move. It was the end of an assumption. And once an assumption breaks, markets never go back to pricing the same way again.